SFM Chapter 8 Problem number 30. According to this question, the total market value of equity shares of Dharam Company is 60 lakhs and total value of debt is 40 lakhs. So from this we can understand that total liabilities of the organization is 1 crore. So liabilities is equal to assets. So total value of the company is 1 crore. Then the treasurer estimate that the beta of the stocks is currently 1.5 and that expected risk premium on market is 12%. Risk premium is nothing but risk return on market minus risk-free rate of return. Okay, so the treasury bill rate is 10%. This is a risk-free return. So from the question we can understand that total value of the organization is 1 crore, risk premium is 12% and risk-free rate of return is 10%. From this we have to calculate point A. What is the beta of the company's existing portfolio of assets? So we need to calculate only beta for existing portfolio of assets only. Okay, so point B, estimate the company's cost of capital and discount rate for an expansion of company's present business. So let's go to answer. According to solution, first of all we have written whatever data available in the question. Beta of equity 1.5% and beta of debt risk-free rate 0. There is no risk for debt, that is why it is 0. Value of equity is 60 lakhs, value of debt is 40 lakhs. We have to calculate beta of company assets, that is what the first point of the question. Then risk premium is given 12% and risk-free rate of return is 10%. Further, D plus E, that means debt plus equity is 1 crore. So to identify beta of assets, we have to consider beta of assets as beta of A. Beta of A is equal to undiversifiable risk of equity, that is beta of equity into equity divided by total value of liabilities into 1 minus tax rate. Tax rate is not given, so debt plus equity into 1, that means 1 crore plus beta of debt, that means undiversifiable risk of debt into debt into divided by total value of liabilities into 1, debt plus equity into 1 minus tax rate, that is equal to 1. So when we substitute the values given in question according to the formula, beta of equity is 1.5, equity is 60 lakhs, total value of equity and debt is 100 lakhs, and next beta of debt is 0 and into 40 lakhs, that is debt, divided by debt plus equity into 1 since no tax rate. So that's how we can find beta of asset value. Finally, beta of asset is equal to, that means undiversifiable risk of assets is equal to 0.9. And secondly, according to the question, we need to calculate risk cost of capital, estimate the company's cost of capital, and then a discount rate for expansion of the company's present business. Okay, so cost of capital can be indicated with KE. This is we can refer to this in CMA intermediate FM. Cost of capital is KE. K is equal to risk-free return plus risk premium into rate of undiversifiable risk of portfolio. Beta P is equal to that means undiversifiable risk rate of portfolio. So risk free rate is 10, plus 0.9, that is what we calculated in above, beta of assets into risk premium we can get it from question. So cost of capital is equal to 20.80. And third, in second question we can see that from second point, and the discount, we need to calculate discount rate for an expansion of the company's present business. For present business, since there is no difference between risks and values of assets and liabilities, in case of expansion plan for this business according to these values, uh, discount rate can be considered as 20.8. In case if there is any difference, diversification plan according to those values, this cost of capital rate may increase or decrease. That is why in point 2 we can see, in case of diversification plan, a different discount factor would be used depending on its risk profile.